Bill, I'd love to get your take on the overall market environment when we're in this period where we're heavily reliant on tweets, we're dealing with issues where hardly anyone has any edge. Is this an area where you find a lot of ideas happening, or is it too treacherous?
Well, as you know, at Oakmark, we're trying to look past the short-term news flow and try and anticipate what investors will think businesses might be worth years from now. So I look at an area where we're very heavily invested in, say, banks, Ally Financial, Capital One, Bank America, Citigroup. These are companies that are selling at 8 times expected earnings today. Historically, they've sold at more like 3/4 the market multiple, so about 12 times. We've owned them for a few years. We've got a lot of patience when fundamentals are going the way we expect them to. And I think 3 years ago, if you had said Ally Financial is going to earn something like $360 in 2019, you might have guessed the stock would be selling in the mid-40s. Instead, it's under 30 today. 90% of book value, 8 times earnings. Cap One, Citigroup, also at about 8 times earnings. We think they're tremendous values.
Can banks rally with yields low and moving lower?
I mean, yes, I think they can. If short-term rates go a lot lower, then the deposit franchises that these banks have won't produce as much current income as they do in an environment where interest rates are more like the level of inflation. But I don't see any reason to project that long-term, short-term interest rates will stay below the inflation rate.
Kirk, what about you? How are you navigating through the volatility? And would you say it's safe to be in the market with continued prolonged uncertainty now over U.S.-China trade relations?
Well, I think you want to take advantage and exploit the volatility on both sides. On the upside, I think that if you're happy with where you are year to date, we've had a great year. I think you want to take some of those gains. There's nothing wrong with doing that. And on the downside, I think you want to look for stocks that have fallen below their 200 moving day average. So we own these great stocks. You want to look at things like the Amphenol, the Texas Instruments. And if the trade wars get very protracted on the downside, you want to look at a stock like Caterpillar with a 3.25 dividend yield. It's very much a function of the trade wars. So to my point, I think you want to take advantage on both sides of the volatility.
Bill, when it comes to oil, obviously we're seeing some M&A activity in the pipes. You got a ton of geopolitical risk. What's your general take on the space?
We like the U.S. E&P companies. We own a lot of Anadarko. We were pleased with the process there that resulted in a good bid for the Anadarko shareholder. And we think the 7 times cash flow price that the Occidental bid ended up being for Anadarko is a number that makes a lot of the U.S. E&P companies look very cheap. We also own Apache. At 7 times EBITDA for Apache, you'd be almost twice the current market price. So it's a space we like a lot.
The question, of course, Bill, is are you going to see more consolidation? Everybody would love to talk to about a 62% premium on whatever their favorite name is, of course, as Anadarko ultimately received. But it's not clear that we're necessarily going to see another deal or deals, is it?
No, it's not. It's not clear at all that there will be more deals. But I think these companies are showing earnings and cash flow levels with oil now in the low 60s that prices higher than the current level are supported just by current income. And we think long-term oil prices need to go higher to support global growth.
Kirk, what about you? How did the commodity picture and rates picture and currency, which we saw hit Walmart so hard today, impact stocks? Where are the correlations right now that you're watching?
Well, I think you have to look at the correlation between the stock and the bond markets going forward. I think what's really interesting to me is that year to date you've had stocks and bonds pretty much rallying in sync. And I think the big question is, what's the relationship between those two markets going forward? Are rates going to back up and stocks are going to go down, or are we in a lower rate environment, protracted, and is this going to continue? I mean, if you look at a 2.3%, 2.4% 10-year Treasury, an 18p multiple is not unreasonable. So the institutional market is really wondering what's going to be the correlation between stocks and bonds going forward.
Speaking of rates, Bill, I see credit card interest rates are getting close to 17%. You got to go back to the mid-90s to see numbers like that. We got some Q1 delinquencies as well yesterday, highest in about 6-7 years. I mean, I understand why that might, the actual rate is positive for some of these financial companies, but are you worried at all about overall consumer strain?
I would say no, we're not worried about consumer strength. You look at a company like Capital One, where credit card lending is their major business. They're earning good margins today. They are not seeing a big increase in their default rates. You see a little bit of a seasonal increase, but you see that every year. But year over year, things look pretty good, and the stock's at 8 times earnings.